Ever watched your portfolio plunge and panicked sold, only to see it rebound days later? Or chased a hot tip on social media and regretted it? Today, we expose the hidden psychology traps that trip up investors and how to sidestep them. Welcome to Dumb It Down, where we cut the jargon, keep it snappy, and make big ideas simple. If you're new here, smash that subscribe button and ring the bell so our videos come to you fresh from the oven. Investing Psychology 101. Investing isn't just about charts and data. It's driven by our minds. To decide fast, our brains rely on mental shortcuts, called biases, and emotions like fear and greed. But those helpers can lead you off course. Let's explore the main mental pitfalls. The illusion of control. We all want to feel in control, but markets respond to global events, economics, and chance more than any one person. Hot hand fallacy. Believing a winning streak guarantees the next win, like thinking a basketball player who's made 5 shots is due on shot 6. Gambler's fallacy. Thinking that after losses a win is due, so you double down on a sinking stock. In reality, market moves are independent. Overconfidence fuels risky bets and sharp swings in your portfolio. Fear and greed. Two emotions, fear and greed, drive extreme moves in markets. FOMO. Social media hype makes you buy at the peak, only to watch prices fall. Fear of loss. Panicking during a downturn and selling at the bottom locks in losses. Greed. In a rally, you pile in too late or take oversized bets, like overloading at a buffet just because the food looks great. Emotional extremes amplify boom-bust swings. Common behavioral biases. Our brains use shortcuts to speed decisions, but these can mislead. Confirmation bias. Seeing only what you want, like wearing rose-colored glasses that filter out anything that doesn't fit your view. Anchoring bias. Clinging to the price you paid, even if the market has moved on. Herd mentality. Following the crowd, buying or selling simply because others do, without your own analysis. Biases lead to holding losers too long or buying into bubbles. Overcoming emotional investing. You can fight back with smart habits. 1. Set clear rules. Define in advance when to buy, sell, or rebalance so you don't react to every market twitch. 2. Dollar cost averaging. Invest a fixed amount on a schedule, no guessing when to jump in. 3. Long-term mindset. Think like a gardener. You plant seeds and nurture growth, not dig up your garden every day to check sprouts. Taking control of your finances. Level up your process and mindset. Keep learning. Use courses and podcasts to master market basics, like learning a new language. Practice mindfulness. Pause and breathe before trading to calm emotional impulses. Use technology wisely. Robo-advisors and auto-invest features can enforce discipline, but check in regularly to catch any glitches or market shifts. Get objective help. A financial coach can offer guidance and keep you on track when emotions run high. Investing is a long game. By spotting biases, mastering emotions, and using the right tools, you'll dodge common mistakes and stay aligned with your goals. What's your biggest investing challenge? Drop it in the comments. If you enjoyed this video, hit like, subscribe for more psychology-backed finance tips, and share with a friend who could use a mindset reset.